I'd like to take a moment to welcome you all. Thank you for joining our webinar on this rainy Monday in New Hampshire. I hope the weather's nicer wherever you're joining from, if you're not in New Hampshire. I'm Paul Carantona, an Assistant Director with UNH Alumni Relations, and I have the privilege of introducing our speaker today. This webinar is part of our Alumni Relations series. Webinars are being scheduled throughout the next few months, so please check your email, follow our social media, and see our website for upcoming programs. All webinars are recorded and can be viewed on our website. We've had a great response to our webinars and hope you will continue to join us for future sessions. Today we are joined by Steve Ciccone. Steve is an Associate Professor of Finance and the current Chair of the Department of Accounting and Finance in the Paul College of Business and Economics. He holds bachelor's and master's degrees in accounting from the University of Florida and a PhD in finance from Florida State University. He is a certified public accountant, formerly employed by Arthur Andersen. He has been a professor at the University of New Hampshire since 2000. Among his research interests are stock return properties, analyst forecasts, and behavioral finance. Before I turn this over to Steve, I would just like to say he'll be taking questions throughout the webinar. If you have questions, please utilize the Zoom Q&A function, which you can find typically at the bottom of your screen. Please do not submit questions via the chat function because they tend to get lost sometimes if people utilize the chat. Please use the Q&A function. And with that, I'd like to say thank you and turn this over to Steve.
Okay, great. Well, thanks a lot for that introduction, Paul. And it's a pleasure to be here. And I hope everybody is staying safe and healthy during this very chaotic time. And so definitely that chaos has basically manifested itself into the investment markets. And so in this particular webinar, I'm going to be talking about investing during recessions and crises, and I'm going to look at a historical analysis. So I'm going to get started. Basically, we've had this amazing effect that this virus has had on the economy. We've had businesses shutting down, record levels of unemployment, interest rates being slashed, oil prices collapsing, and then the government is stepping in and providing billions of dollars in stimulus, trillions of dollars in stimulus, a few trillion already and perhaps more. So overall, we really have this situation where there's just a tremendous amount of uncertainty. There's uncertainty about when the virus is going to end, when the virus actually does end, when the cases start really declining dramatically, when's the economy going to get back to normal? When are people going to be able to be face-to-face with each other in classrooms or at work, et cetera? So there's just overall this really amazing amount of uncertainty right now. So I'm going to look at how does the stock market perform during recessions and crises. And so I'm going to look at the past. So this is a historical analysis. So by looking at the past, I'm hoping to make some conclusions about the future and what things might look like in this present crisis. So I'll notice you have my disclaimer up there. This is a historical analysis, and so I'll say that there is no guarantee of future results. And so that's a usual disclaimer that we have in finance. So there's a lot of great ideas out there right now for stocks. Some people think, for example, Amazon as an online retailer is going to do very well, or Peloton, home exercise equipment, cleaning equipment like cleaning supplies like Clorox. We're all on Zoom right now. So there's some great ideas for individual stocks, but I'm going to note that this is going to be an evaluation of broad market indexes, not an evaluation of individual stocks. And so again, despite these great ideas out there, I'm not going to be able to comment a whole lot on that just because there's a lot more uncertainty with the individual stocks versus the broad markets. As an example, I show Amazon's stock price the last month, and we can see that Amazon, while the market's been in a downturn, has really performed very well over this past month period. So what's going to happen to Amazon in the future? I'm not sure. I thought Amazon was overvalued like 20 years ago. So obviously it's done phenomenally well since then. So again, I'm going to focus more on the broad market indexes. So I'm going to start with kind of giving away the suspense here, but I'm very pro stock in this environment. And I have a quote up here from Warren Buffett. And so he made this quote back in 1986. And he basically says to be greedy when others are being fearful. Okay, so again, I think we're in this fearful environment, so it might be a very good time to start investing in stocks, or keep being invested if we already are. So as I said, I'm going to look at history. So I'm going to go through my data that I use, just so we have an understanding of what we're looking at. But I use, for the past crisis analysis, monthly stock returns. And the data that's typically used in academic research comes from the Center for Research and Security Prices, and this is from the University of Chicago, and they go back to 1926, and you can see it ends in 2019. So I don't get the current data. This is historical data. What's nice is it goes back through 1926, which allows to get a regression. And so I'm going to look at two indexes, the value-weighted index. In a value-weighted index, stocks are dominated by, weighted by market cap or market capitalization, which is price times shares. So it's indicator of the size of the firm. So most of our major indexes, except for the Dow, but other than the Dow, most of our major indexes are value-weighted, like the S&P 500, like the NASDAQ Composite Index. When you have value-weighted indexes, the large stocks tend to dominate, because they're the bigger stocks, they get a bigger weight. There's probably, hundreds of large stocks, and then there's thousands and thousands of smaller stocks that would have a lot less influence on these indexes. So the other index I'm going to look at is the equal weighted index. And so, as I mentioned, there's hundreds of large stocks, but there's thousands of small stocks. So when we equally weight the returns, the small stocks tend to dominate. So the value-weighted indexes tend to be kind of an indication of how the large stocks are doing. The equal-weighted index tends to be an indication of how the smaller stocks are doing. For the present analysis, I'm going to look at daily stock returns, and I'll use the Wilshire Total Market Index. And so this is also value-weighted, and so the large stocks tend to dominate. And I'll also use the Russell 2000, which is an index of 2,000 supposedly small stocks. The stocks are big relative to just the average business, but compared to, say, the typical large stock, they are indeed very small stocks. So the Russell 2000 usually used as a gauge of small stock performance. Now, why is it important to look at, say, large stocks versus small stocks? A lot of people out there believe that small stocks act differently from large stocks. Could be due perhaps to more risk, but even if we control for risk that we typically measure in finance, the small stocks still tend to outperform large stocks. So why that actually happens is a bit of a mystery, but we have this evidence that small stocks do tend to act differently versus large stocks. I'll also note, just for context, the typical stock return in a given year is about 8%. So that's positive. It's a historical average, obviously a lot of volatility from year to year, but again, we can typically expect about 8% per year if we're invested in the stock market. I also want to introduce this term. A lot of you guys might be familiar with this, but dollar cost averaging. And so dollar cost averaging is a very simple investment strategy. We invest the same amount in some recurring interval. So taken very simply, we can say, well, we're going to invest $1 at the beginning of each month. And then we would keep investing that dollar at this recurring interval. And we could see over a long period of time how we perform if we execute this type of strategy. So it's a strategy that tends to spread out our risk level over this investment horizon, better than just kind of dumping all your money in at once. So what are the crisis events that I'm going to be looking at? And there's several. And so I'm going to focus most of my time on the Great Depression. So as we know, the Great Depression lasted from 1929, started with the stock market crash in October, and usually we use the start of World War II in 1939 as marking the end of the Great Depression. There is some controversy with that, but that's pretty standard that the Great Depression is considered to be lasting from 1929 to 1939. It was the worst period of economic activity in U.S. history. What were some of the big issues? We had this very large stock market crash. We'll see what it was in a second. That led to a lot of people either losing wealth directly or feeling like they lost wealth, and that led to a sharp decline in spending. Mass unemployment, deflation, where prices were actually decreasing. We had these banking panics, as the banking system wasn't as sophisticated as it would be today. And this spread worldwide. And so as it spread worldwide, that really led to a decline in international trade, which really helped to make the issues much worse, even as exports were very limited. So as I said, this is the crisis I'm going to spend the most time on. But other crises that we're going to look at, the oil crisis in the early 70s. I was a little bit too young to remember this one, but I did remember these long gas lines in the late 70s. It was a second oil crisis in 1979, 1980 time period. But what was that? We had the longest market crash since the Great Depression. And what were the issues? This issue of stagflation and also very high energy prices. Also going to go through Black Monday, 1987. And so on Black Monday, the Dow Jones lost 20% in one day. International markets also tumbled. What was the nice part of this, though, was that there were very limited longer-term economic effects. This was a very short-term crisis. I want to also mention the tech bubble. And so 2000, 2002, so we had this period in the late 90s where technology stocks rose very rapidly. And then, of course, all that burst starting in 2000. And so we had a dramatic decrease in the NASDAQ Composite Index, which erased nearly all the gain during that prior boom period. And it took a number of years to get back to the level that we were in the late 1990s. So the NASDAQ Composite is often considered to be a very tech-heavy index. And so the most recent one that we're going to look at is the Great Recession, which was from 2008, 2009. And so perhaps a lot of us remember that pretty vividly. The stock market crashed in 2008. And so what were the issues during that period? The housing and mortgage markets, and also these issues of contagion, that this would spread to other financial institutions much, let's say, broader than just the mortgage markets. So the government stepped in with a large bailout, and we'll take a look at what happened to stock prices around that event.
Wonder, Steve, this is a good time for you to jump in with a few questions.
Yep, please.
We have a few questions here, and one question comes in, and when will we know that the federal government is starting to run out of money to fund the economy in lieu of consumer spending? And how does the Fed's interest rate cut either feed into or help the situation?
Yes, so that's a good question. So let me maybe start with the first one, and then I'm going to ask you to repeat the second one, and I'm going to ask you to repeat the first one, Paul. But to answer the second question about interest rates, so usually when we think of interest rates, that's good for the stock market. As interest rates are cut, that tends to decrease what we call the required rate of return. As those rates decrease, then stock prices should increase. So usually interest rate cuts are seen as a good sign. And in the case of the recent cuts, with some of the cuts, the market actually went down. And I think the market interpreted those cuts as a signal that the economy was in trouble, that the Fed is acting to ward off these potential issues. So a lot of uncertainty during that early period with what would happen in the economy. There still is a lot of uncertainty, but I think the market took it as a very bad signal. So usually good. Recently, those cuts weren't received well by the markets, and the market did decline. And so, Paul, if I could ask you to repeat the first part of that question.
Of course, of course. When will we know that the federal government is starting to run out of money to fund the economy in lieu of consumer spending?
Yes, so that's a good question. I'll just say up front, I'm not an economist, so they would probably be able to answer that question better than I can, although I think it's very hard to predict things like this. I'm kind of surprised that they're able to inject $2 trillion plus into the economy. I would think that there is potentially an unlimited supply of money. Of course, the problem with that is that you have inflation concerns. So kind of see what happens, but would I be worried about inflation in the long term? And the answer to that, to me, is yes. So I think as the uncertainty gets resolved, we'll see what happens with that. But yeah, I am definitely worried about inflation. If we inject more stimulus, I would be even more worried.
We have another question.
Yep.
Okay. My overall approach has been to dollar cost average in this market, maintaining my targeted balance of 40% equity and 60% bonds and stable value funds. Would you agree this makes sense for someone just entering retirement? This is separate from a cushion of Social Security and pension monies.
Thanks for that, Paul. So that's a great question. So, a couple issues. One is the dollar cost averaging, which, as you'll see, in the latter part of this presentation, yes, I think that's a great strategy to do. The allocation itself sounds good. The question mentions that, approaching retirement. When people are of, say, retirement age, the life expectancy is usually decades longer. So there's still a long-term outlook. So I think 40% in stock is reasonable. Of course, that would depend on how risk averse you are. As people become more risk averse, they would, decrease the amount of money that they have in the stock market. But to me, 40-60 seems like a nice split.
And then just a final question for now, and we can move on whenever you're ready. But
okay.
It seems like we're having more frequent crisis events. Are we? If so, why?
Yeah, that's a great question. We've definitely seen, I'm trying to think, we have, if we just go back in these slides, we have the Great Recession, we have the tech bubble, we have the Black Monday, we have the present one. So that's, let's say, 3 in the last 20 years, 3 pretty major crises. Are we seeing more? I guess so. I think some of it is just bad luck, like the present one. It's hard to predict these viruses, so this one's just kind of bad luck. I think the tech bubble and the Great Recession were both overheating, so we've had more of these asset bubbles. Are we going to see more? Not sure. It definitely does seem, though, that we have seen a lot of these behavioral effects in the stock market. There's just more money being pumped into the stock market. There's computers making trades, hedge funds buying, selling, etc. So perhaps not surprising that we are seeing more of these bubbles. So in the future, would I expect to see more? I'll kind of be neutral and say not sure. But definitely there does seem to be a lot of bubbles that we've seen recently. Any other questions, Paul?
We have one more, and then yep. I can
Please.
hand the reins back over to you.
Okay.
What is your opinion, timing-wise, on opening a Roth IRA account in lieu of the current economic climate?
So I think any time is really a good time to open up a Roth IRA for especially for those starting to invest. They can invest basically the money, it would grow tax-free, which is a great advantage. As we're going to see in this presentation, I think now is indeed a good time to invest. And so if we were starting to invest and using the Roth IRA as a tool, I think that would be great. So I'd say just investing in general, investing using these tax advantage tools are both great things to do. Okay, anything else, or you want me to continue, Paul?
I'll let you keep going. And
okay.
I'm sure I can stop you later on as more come in.
Okay, great. Thanks for those questions. All right, so let me continue. So as I mentioned, I'm going to focus most of the time on the Great Depression. We'll see what investing throughout that time period looked like. And I'll remind us that was the period of the worst economic activity in the U.S. So first, kind of the bad. So October and November of 1929, the stock market loses about 30% of its value, and that's looking at that value-weighted index. Remember, that one's dominated by the bigger stocks. So a very large decline in those 2 months. However, that was not the worst of it. This decline continued. And so by June of 1932, you can see the stock market lost over 82% of its pre-crash value. So a really tremendous loss of wealth during this 3 or so year period. And so that's you know, as far as I'm aware of, that's the worst stock market decline in history, by far. Took about 15 years, October 1944, so nearing the end of World War II, for the market to return to the pre-crash level. So again, a very significant drop, and a drop that really, it was so bad that it took 15 years to recover. So if we invested during the Depression, though, how would things look? And so I'm going to look at dollar cost averaging throughout the Great Depression. Assuming that we're starting in October of 1929, we're investing $1 per month. Just to be simple, we could make it 1,000 and just multiply the numbers all by 1,000, for example. But just to be simple, I'll use $1. And so I look at different breakpoints throughout the Depression and even a little bit beyond. But if we were investing that $1 per month for 34 months, and that's going to lead us to the trough, which is the low point, June 1932, our $34 that we invested would have decreased to $13.32. So you can see we would have had a really, really poor return, poor investment performance during this period of time when the market is dropping 82%. Okay, so not surprising we would lose a lot of money, even if we are being a little more conservative in dollar cost averaging. So if we kept going, though, what happens? So you can see the break-even point with our dollar cost average strategy was in August of 1934, would have invested $60. That $60 would have actually turned to $62.06. So we would have made a couple bucks if we kept investing through, past that trough period. If we kept investing throughout the end of the Depression, we wouldn't, that's 10 years, dollar per month, so 12 months per year, $12 per year, 10 years, $120. That would have actually led to us getting $156.84. Okay, so again, that's our dollar cost average strategy through the worst period of economic activity in the United States. Okay, yes, we would have been doing very poorly early on, but you can see we would have actually ended up with a positive gain at the end of the Depression. If we kept on investing, you can see, let's say if we invest through the market returning to that pre-crash level in 1944, our $182 invested would turn into a nice $346. So very nice returns after the Great Depression ends. Actually, the market returned about 40% at the start of World War II. So that's not included in this number here because that's past the Depression, but a very nice monthly return. So there's kind of the good side of investing during the Depression. The average monthly return, perhaps surprisingly, was actually positive during the Great Depression. So that's the average each month over that 10-year Depression period. The return from the trough, which we said was June 1932, through the end of the Depression was actually 250%. So from that trough through the end, we get a nice return. And through that 1944 period where the market returns to the pre-crash level, we get a 570% return. So you can see we actually had very good returns throughout a very large portion of the Great Depression. Now, what if we invested in small stocks? So remember that value-weighted index that we just looked at, that was dominated by the bigger stocks. Well, what if we looked at the equal-weighted index, which is dominated by the smaller stocks? Our monthly return now jumps about 10 times to 1.1% on average. Again, throughout the Depression, the worst period of economic activity in the US, we get a nice approximately 12% return per year. The return from that trough period, June 1932 through the end of the Depression, was almost 600%. So a very nice return. And you can see over 2,000% if we invest through the market returning to that pre-crash level. So small stocks, you can see clearly enhanced our return during the Great Depression. So what did things look like during other recessions and crises? And Paul, any questions on that, by the way, before I go on?
We've had a few questions trickle in,
okay.
And so I can pose them to you, and you can pick which ones you want now, and others we can push to later if you'd like.
Sure.
So we have some questions here that say, let's see, excuse me. How do you think about how or what do you think about the circuit breaker mechanism that attempts to temper volatility in markets? In the last few months, it was triggered several times. Are the bounds too tight?
So that's a very good question. The circuit breaker was instituted. Actually, we'll see the 1987 Black Monday crisis in a moment here, but that was instituted soon after that in reaction to that, where the Dow Jones dropped about 20% in one day. It's been used, I believe, twice since it was instituted, except for it's been used twice in the latest crisis. So that's a total of 4 times. So not a whole lot of data to go by in terms of how effective it is. However, some do believe that triggering the circuit breakers in the current crisis did help. The theory behind those circuit breakers is that, and let me maybe mention what the circuit breakers are in a second too. So the circuit breakers are right now, if the S&P 500 drops 7%, we have a 15-minute trading halt. Okay, and the theory behind that is that during those 15 minutes, investors will calm down, they'll get new information, so the craziness won't be stopped necessarily, but it will be at least alleviated. If the market drops 13%, then we'll trigger a second circuit breaker, another trading halt for 15 minutes, and if it drops 20%, it'll stop the trading for the day. And again, that was those circuit breakers were activated twice in this current period. Are they too tight because it's so rare? I would say it's probably not that tight, because 7% is a big, significant drop. Rare enough that this present event is indeed considered a major crisis.
Excellent. We have a question here. I know the standard advice from financial advisors is to never sell after a market downturn. In recent weeks, we've seen a huge downturn followed by a modest upturn. Here's my question. Given the clear prospects for further erosion of the market as COVID-19 crisis continues, is this a good or bad time to sell stock and move into seemingly safer bonds?
So, yeah, good question. Wish I knew the true answer to that. My advice is going to be basically the general advice of most professors is to buy and hold. Do we want to compare this current crisis to the Great Depression, where it's going to be an extended crisis, or is it going to be more like the 1987 Black Monday crash, where it was very short-lived? And so, not sure what the answer is going to be. Is this going to disappear in the summer, or at least be reduced a lot in the summer? Is it going to continue? Is it going to be a second wave, et cetera? So there's still a lot of uncertainty. I think there's a good chance we have not reached the trough. But again, my standard advice is just going to be to continue to invest, to continue to execute whatever stock strategy you had before, continue to execute that strategy through this crisis. So, I'm looking mainly at long-term investors. If an investor is more short-term, then obviously they're going to be, a lot more risk averse. But looking at the long-term investor, I'm going to say stay with your strategy, invest through this crisis. And at the end of the crisis and, beyond, we're going to potentially see some nice returns. And I'll go through the history of those other crises in a moment here. We'll see basically that exact scenario play out in those other crises.
Backing off of that, what your answer just then, we have a question for someone in their 80s. Is there an allocation that you advise?
So, that's going to depend a lot on how risk averse a person in their 80s is. The life expectancy of a person in their 80s is still quite long. So I would say, if a person was a little bit more risk averse, they would be probably very low in stocks, like 10, 20%. If they're more risk, if they're willing to take on more risk, then they might be even a little bit higher. And it would, of course, depend on what their plans are with the money. Are they planning to give it to their heirs? Things like that. But, I'd say for the typical person in their 80s, the average in the stocks is probably going to be somewhere around 20%. Okay, any other questions, Paul?
one more question before we
Sure.
continue on with you. And let's see here. Excuse me. I was forgetting the acronym here. As I'm paying attention, I'm positive. But for DCA, focuses on future investments. What are your thoughts on current holdings? As an extreme example, would you suggest liquidating and then beginning to DCA, which was your reference to dollar cost average? Excuse me.
Okay, Paul, if I didn't quite get the question, if you could just repeat that, please.
So for dollar cost average focuses on future investments.
Yeah.
What are your thoughts on current holdings? As an extreme example, would you suggest liquidating and then beginning to dollar cost average?
Yeah, so that's a good question. I definitely would not liquidate if it were me. But if it were me, I would not liquidate at this period of time. I would keep investing throughout this crisis period. And so, the problem with liquidating stocks now, or let's say waiting for a dollar cost average strategy, is that you might miss out on these recovery returns. We saw with the Great Depression, even actually this present slide, 1932 through the end of the Depression, we get a 600% return. If we're waiting for the Great Depression to end, or this uncertainty to be resolved, we might be waiting a long time. We might miss out on a lot of this return. So that's why my standard advice is to kind of keep investing throughout this period. Don't liquidate. If you're dollar cost averaging, now is a good time to start if you haven't done it already. Okay, other questions, Paul?
We have a few here, but I think some of the things you're going to be getting to shortly.
Okay. Okay, so I'll keep going. So we saw the Great Depression. Again, we saw some very nice returns throughout a very large part of the Depression. What did other crises look like? So we'll look at the oil crisis. In that value-weighted index, which again was the larger stocks dominating, we saw a 41% decline over a couple-year period. We then saw that followed up by a 37% recovery return. And if we're in small stocks, the equal weighted index, we actually got almost double. We got a 64% return in that recovery period. Black Monday. Remember, this was a shorter lived crisis. We saw a 28% drop in that value weighted index in October and November of 1987. But over the next couple year period, we got a 51% return. If we were in small stocks, it's actually one of the few times that small stocks don't outperform during these recovery periods. Small stocks, though, we still would have gotten 33% during the next couple year period. And remember, the context is we get about 8% average per year. So if we're getting 51% over 2 years, about 25% year on average, it's a very nice return. Okay, the tech bubble, what did that look like? So we saw a 45% decline over a couple year period. That was followed by a 50% return over the next couple of years. And if we're in smaller stocks, we got a 210% return. Okay, so about 4 times the return on the value weighted index. Okay, in the Great Recession, a value weighted decline of minus 41% over that couple year period. 86% recovery returns. If we're in small stocks, we got 236%. And that's those recovery returns over about a year and a half period, a little bit longer than a year and a half period. So very nice returns coming out of that Great Recession, which then led to an extended bull market. On this next slide here, we have the S&P 500, 2007 through the present. And you can see it was kind of maybe rising a little bit, maybe a little bit flat during that pre-Great Recession period. All of a sudden, we had that very significant drop. Okay, it looks like right around early 2009, the market starts to recover, and it's gone up since until the present crisis. So we got a really nice extended period of some great returns after the Great Recession. Okay, so on this next slide, I look at what would a dollar cost averaging strategy look like? And so it's a little bit text heavy, so excuse that, but I wanted to show the start of the crisis. I wanted to show the trough. And then when, if we were dollar cost averaging, did we wind up breaking even? So you can see in the 1970s recession, as an example, we have a trough of 41% over this couple year period. But if we kept with our dollar cost averaging strategy, we would have broke even within the next year. Okay, so a fairly short period after reaching that trough. And if we kept on investing, say if we held our investments, the market returned to its pre-crash level in 1978. So about, say, 5 years after the start of the crisis. Again, the 87 crisis was much more short-lived. We reached the trough in November of 1987, but if we were dollar cost averaging, we would have broken even in January of 1988, so just a couple months after the trough. And the market went back to its pre-crash level in 1989. So again, just a couple years or so after the crisis event. And we see a similar story with the tech bubble and also the Great Recession. The crisis itself might last for a couple years, at least in the 70s recession, the tech bubble and the Great Recession. We do see this trough occurring a couple years, say, or so after the start of the crisis. But if we continued with our dollar cost averaging strategy throughout the crisis, we would have broken even just a short time afterwards. And then again, we get these great recovery returns. So what do things look like now? And so I'm just going to give us some very basic information here. There's not a whole lot out there yet in terms, we don't have the history yet, say, but the Wilshire 5000, which is a broad market index, usually it has more than 5,000 firms in it, even though despite its title, but that was down 35% from its all-time high February 19. We've had a nice return since the trough on March 23rd. So we had a 26% return from then. So currently it's down about 17%. And so we'll use that as kind of our broad market / larger stock index. And then we said the Russell 2000 was going to be our small stock index. And you can see that that one is doing a little bit worse. That's down 41% from its peak. Currently down 27% after we had a nice 23% return from that trough. And looking at the market at about 11 a.m. today, it was up approximately 1% or so. So not sure what it's been doing since then, but it looked like it was up a little bit at that time. Okay, so I'm going to reach some conclusions here. So maybe, Paul, if there's any questions before I reach the conclusions.
I'm happy to give them to you now. If you'd like to wrap up, then we could also save questions for the end.
Sounds great. All right, so what are my conclusions? So we've seen in these crises solid returns generated during parts of these past recessions and crises. For example, we had several years of very strong returns, even during the Great Depression, the worst economic event in U.S. history. And definitely adding those small stocks to our portfolio can enhance our performance. We've seen those double, triple, or even quadruple the return on the larger stock indexes. If we want to reduce our fear of investing, if we don't want to just kind of jump all in at once, we can dollar cost average through the crisis event. So going forward, what's going to happen? So my prediction is we're going to still have a lot of volatility over the next few months, potentially even longer. So there's still going to be a lot of uncertainty. That uncertainty does result in all this volatility that we're going to continue to see in the stock market. But if we are long-term investors, I would recommend staying invested to receive these recovery returns. Not sure when these recovery returns are going to happen, but I would stay invested to make sure that I get those when they do happen. Small stocks may outperform during the recovery. We've seen small stocks outperform during every single crisis except for that very short-lived 1987 Black Monday crash. And I would dollar cost average through the event and then beyond. Always a good strategy. And definitely if you want to keep investing during these crisis events, it's a good strategy during these events. And again, you want to keep investing beyond it to make sure you do get those recovery returns. Okay, so that concludes my show here. So now, Paul, feel free to fire away at the questions.
Absolutely. Thank you very much. First of all, thank you very much. We had quite a few questions come in. Sure, more will come. Do you think this would be a good time to convert some of a traditional IRA to a Roth IRA?
Yeah, so that's going to depend on, I'd say, the investment horizon. If your investment horizon is long, if, for example, like your 30s or so, you still have like a 30-year plus investment horizon, I would say, yeah, it might be worth looking at that conversion. If your investment horizon is much shorter, then I would probably not recommend making that conversion. So that's going to really depend on the time till retirement.
Excellent, thank you. The recent market response seems disconnected to the sharp rise in unemployment and precipitous drop in business activity.
Yeah.
Is there a reasonable explanation for this?
Yeah, so we usually think of the market as being a leading indicator of the economy. So in my opinion, the market is very optimistic about the economy turning around. We saw, if I just go back a slide, or a couple slides, we saw, these nice returns, 23, 26% depending on our index from that trough, period. So it seems like the market is pretty optimistic. I am personally less optimistic. So I would not be shocked to see if the market does indeed have another downturn. I wouldn't even be shocked if we did not reach the trough yet. The trough was about 35%, 41% of an index. That's typical of the troughs that we see during these crisis events, about 40%. The Great Depression was the exception, that it was down, we mentioned, over 80%. But, I would not be surprised if we would hit, let's say, a second trough that would be potentially even lower than this first one. But, again, my recommendation would be to keep investing because I'm not sure what's going to happen. And we might miss out on those great recovery returns.
Excellent. Thank you very much. Is the equal weighted index generally outperforming the value weighted index due to small stocks dropping further than larger stocks during the crisis and then recovering?
Yeah, so that's an excellent question, and it's one that's hard to answer because basically a lot of research goes into that, but the research is mixed. So the small stocks should be riskier, right? Because they're smaller, they're newer potentially. Their earnings might be more volatile, but when we tend to measure small stocks performance using risk-adjusted measures, they still tend to outperform over long periods of time. So small stocks do have what we call beta. Beta is a measure of risk. The higher the beta, the higher the risk. What a high beta would say is that if the market goes up, our high beta stocks would go up even more. If the market goes down, our high beta stocks would go down even more. So we're going to have more volatility in up and down markets. So small stocks, yes, on average, they would tend to go up more. They would also tend to go down more. So part of their outperformance would be definitely during these crisis events. What's nice about this most people, when they invest in bigger stocks. Right? If they invest, for example, in stocks that they know, like Amazon or Nike, or they invest in broad market indexes, especially like the Dow or S&P 500. Mutual funds are typically where we see the small stock investments. So if we have mutual funds that either invest in the broad market or if they tend to target small stocks, that's where we'd usually see those investments. But if we are confident that small stocks outperform, I would say now is indeed a good time to start investing in small stocks, targeting, let's say, a Russell 2000 index. Very easy to buy those indexes now with these ETF securities. But if we start investing in small stocks now, and indeed they outperform, we would really capture a lot of that outperformance.
Maybe more of a predictor for you, but just curious your thoughts. Do you think the S&P will test the lows experienced in March?
Yeah, I wouldn't be shocked if it does. So as I mentioned before, related to that economic question, that there is this disconnect. There is a disconnect in my mind, and the market is usually, academics think the market is efficient, which means all the information that is known is in the market. So the market tends to be accurate. But I do think there was some optimism. And so I don't feel like this is something that, even if we were back to normal tomorrow, let's say, in terms of people being at work, I don't think that the spending and unemployment would be would come back to normal soon after that necessarily. So I think this is going to be a little more extended than the market believes, perhaps. And again, that's just my opinion. But because of that, I would not be surprised if we did see the S&P kind of reaching that trough again, at 35, 40% decline again.
This downturn feels different, probably due to banking not being a major factor in the cause. At what point will the financial system be strained to the point we see the effect in financial stocks?
Yeah, so that's a good question. I mean, the financial stocks are down, perhaps not as down as other stocks. I haven't done that analysis. Right now, because of all the stimulus packages that the government has put through, or perhaps will put through in the future, I think that's really what's keeping, the economy overall afloat in terms of the stock market. I should say really the stock market afloat. That perhaps the reason why the stock market hasn't maintained that really low level, why it has indeed gone up the last month or so. So I'd say, yeah, banks can potentially benefit from this stimulus. And so it's a good observation that this one is not caused by really something that's kind of internal in the economy, just caused by this totally exogenous, this external event. So it definitely is a little bit different. At the same time, I think the same principles would apply when it comes to investing. And so, that's why I would recommend staying invested. Yeah, I think the financial sector could have some issues, I suppose, if we have the inflation. So that's my big concern with all the government spending.
Question here: do you have any advice for people retiring in a year or two?
So if you're retiring in a year or two, you're going to be less invested in stocks than a person who's, let's say, just entering the job market, of course. So depending on your level of risk aversion, you could kind of figure out your level of allocation to stocks. My advice would, assuming a person has a normal level of risk aversion, I would say roughly, maybe 40 or 50% in stocks. That might be a little bit higher than some might suggest. But as I mentioned earlier, if a person is retiring, the expectation is that they're still going to be spending for decades. And so if you want return during this period of time that you're spending money, the stock market has unquestionably provided the best return over the last 100 years or so. And probably before that, we just can't really measure it before that because we don't have the data. But the stock market has definitely been the best source of returns.
We have a question here, a little bit of a setup for it. It says, not every financial professional would recommend dollar cost averaging. Not every downturn is alike. Dollar cost averaging, as with any other strategy, must be reevaluated in light of the unique attributes of the current market. Catching a falling knife is painful and the results can be lasting. So assuming the same tool is not right for every job, what are your proposed alternatives to dollar cost averaging, if you have any?
So, yeah, the alternatives are, the extreme alternatives, I'll say, are 1, going all in, or 2, getting all out. And so the risk of going all in is that, we still haven't hit the trough, and that if the trough is still to come, that we're going to lose our money that, basically we're going to lose 1% of all our money because we just went all in. And then it's going to take us longer to recapture that money that we've invested. The counter to that would be that the market in the long term, at least over the past 100 years or so, has consistently gone up. So basically, no matter when we start investing, if our investment period is long enough, we will have made money. That would be kind of if you're really, hey, I'm willing to take a lot of risk. I don't mind if I lose some money in the short term, going all in, could be an interesting way to go. Again, I wouldn't necessarily recommend it because very few people can handle that level of risk. So the other extreme would be just exiting right now. And so if a person did that, then, as we come out of these crises, we'll potentially miss out on the recovery return. The problem with getting out of the market is you're trying to time the market. Assuming you do want to get back in, you're trying to time the market, and it's so difficult to time the market. They've been studying, academics have been studying how to time the market for 50 years or so, and really the conclusion that I get from all the studies that are out there is that it's really, really difficult to time the market. So if we were to exit the market, we would potentially miss out on these really great recovery returns. And that's the risk there.
Thank you. And I just want to say to everyone, I'm cognizant of the time. Steve has been very gracious and said he's happy to go a few minutes past. So I'm trying to get some of the questions that are more broad-based before we get to more specific ones, but we'll get through as many as we can. We actually have a few questions that are kind of similarly worded, so I'll just ask one. But essentially, given the unprecedented economic shutdown and the potential for unemployment not seen since the Depression, is it possible to get a sell-off after this recovery that replicates the 70% sell-off from the 1930s? There's a few questions about people wondering if there's any insights of that 70-80% drop that you kind of alluded to from the Great Depression.
Yeah, so I'm not anticipating that big of a drop. The Great Depression was a different time period. And I'm not much of an economic historian to really know all the ins and outs of it, but the Great Depression, the problem was deflation, where prices were actually coming down. We haven't been deflationary really since the Great Depression, as our money supply has been consistently increasing. The other big factor with the Great Depression was, and we can kind of argue whether this is good or bad long term, so the next 50 years or so, but the government was, the Fed, I should say, was very slow to react to the Great Depression. The monetary policy didn't really follow along with what was going on with the events. So we had these very large fiscal stimulus packages with the New Deal. But I guess depending on how you feel about FDR, they were kind of mixed success. So to me, this event is going to be different from the Great Depression, although I do make the comparison of the Great Depression and potentially this event being a longer extended crisis. So the Great Depression lasted 10 years. I don't expect this to last 10 years, but perhaps it can last a couple of years. And so, we do have that potential for the extended crisis. So I kind of make more of the comparison with that as opposed to the economic situation at the time, because I do think we're in a very different economic environment. The Fed stepped in very quickly. The government stepped in very quickly with fiscal stimulus packages too. We didn't have to wait till, let's say, an election. And so I think that could be something that's very different from the Great Depression.
We actually have some questions just about your thoughts on just the stimulus from the government in general, about kind of government debt and the deficit. Debt pushing 30 trillion.
Yeah.
The U.S. dollar collapse as the world reserve currency. What are you concerned about hyperinflation, or maybe using gold, silver, or real estate as a hedge?
Yeah, that's an excellent question. Wish I had answers on that one. Yes, I am worried about inflation. Okay, I think the debt was already high. Usually, when we think of high levels of government spending, we're thinking in billions. Right now, we're talking trillions. So, this is unprecedented. Why we can basically provide so much money to the economy is very simple, because the dollar is the reserve currency. If that were to stop, then yes, we could see a real collapse of the dollar, which could lead to hyperinflation, no question. As the counter to that, though, I'd say, this event has really caused economies around the world to suffer. So while the U.S. government and our stock market has declined, our economy is in trouble, it's also a worldwide event. So as if the U.S. can provide, say, some stability, or I should say maybe relative stability during this time, then I think the dollar would still continue to be used as the reserve currency worldwide. However, great question. And, to me, whenever you start spending or injecting trillions of dollars into an economy like the way we are doing, you always have that risk of inflation.
Do you, or rather, actually, are kind of the collective we, and like we in quotation marks, are we underestimating how strong the market has actually been in the last 4 weeks? Meaning that although it had a rough late March, it actually has recovered pretty well in April.
Yeah, so I think that's very possible. Given all the uncertainty around this event, given that we don't know when it's going to end, when things will go back like fully to normal, going back fully to normal could take even several years. But yeah, I think there's still a lot that needs to be resolved, and the stock market's going to have to kind of work through all of that. I'd love to see that V-shaped recovery, as some have alluded to, but if it was a U, I would not be surprised.
Do you have any advice for day trading in today's market?
Yeah, that's a good question. I'm not a day trader, and most academics don't typically recommend day trading. So yeah, unfortunately, I can't provide any advice. I wish I had some. Most academics, though, recommend trading over a long period of time. Buying and hold is a standard recommendation that you'll get from academics who study the stock market. Day trading is very risky. It could, of course, work. I think how well it works is partially attributable to luck, although obviously a lot of investors out there would disagree. A lot of hedge funds out there might disagree. But again, I kind of like to stick more to the long term. So I wish I had some advice, but unfortunately I don't.
I'm sorry, I'm scanning through the questions to see when there's some maybe very, very specific ones that maybe we could answer outside of the call potentially.
Sure.
So excuse me, folks, if I don't get to your question. I'm just being mindful of the time. It might be broad-based. Excuse me as I'm going through here. So this question here: if you did move money into cash when the market was at its lowest point, how would you go about getting back into the market now?
So that's a really good question. So I'll kind of go back to my extreme case. You have the two options. One is the just throwing it all in right now, and two is throwing it in more slowly. And say with that second case would be more of a dollar cost average strategy. And I'll say too, there's other strategies that are kind of related to dollar cost averaging strategies. Dollar cost average is the simplest one, so that's why I kind of focused on that. But as an example, instead of investing the same dollar amount each month, we can invest something like the same value each month, and there's certain advantages to those type of strategies. But most people, again, are a little bit more risk averse, so they wouldn't want to just kind of jump in all at once. So I would say if it were my money, and let's say for convenience I had $12,000 to invest, I would probably be looking to invest about $1,000 a month over the next year. And so even if this crisis period lasts longer than that year, that's at least a slower way to get into it. And I wouldn't feel as vulnerable as if I dumped all my money in at once. So you could really shorten that time period too, depending on your level of risk aversion. If you were a little more of a risk taker, but didn't quite want to throw all your money in at once, you could maybe invest over 6 months or 8 months or something like that. But I would say a year or so period to dollar cost average would really help, at least the psychology of the investor in terms of spreading out that risk a little bit.
We have a kind of a tax advantage strategy question.
Okay.
This individual asks, and there's some other parts to it here, but what are some tax advantage strategies that make use of the depressed market? For this person in particular, they have already recharacterized some of their traditional IRA into Roth to reduce their taxable income per share. But what are other strategies? And this individual says, unfortunately, I do not have enough cash to actually make additional market purchases since I maintain only emergency cash with small net expenses. So with that in mind, what are some of the tax strategies you have?
Yeah, so, when you invest in stocks, the real tax benefit that you get is that you don't realize any return, let's say, any capital gain, I'll call it. So you don't realize the capital gain until you actually sell. So say, for example, if I buy a stock today for $1 and it goes up over the next 10 years to $100, I have a $99 capital gain there, but that $99 isn't realized until I actually sell the stock. So that's a nice tax advantage of stocks. Yes, dividends are taxed, but dividends are taxed, at least the last 20 years or so, at a lower rate. They're taxed about 15% today, which is lower than most people's marginal tax bracket. So that's one advantage, just investing in stocks in general. You mentioned in the question the big tax advantages, the advantage investment tools, and the IRA is the big one. Of course, there's 401ks, 403bs, things like that too. But just for the personal investor, the IRA is the big advantage. If an investor is younger, typically the advice is to use a Roth IRA. If the investor is older, then just use a traditional IRA. But the IRA is really the go-to for a tax-advantaged strategy.
We have a few questions actually about 401ks.
Okay.
And we probably have time just for a few more questions. And we'll try to, for the questions we still have in here, we'll try to share those with Steve, and maybe we can send out some answers via email potentially. But but there's the questions that we can answer. Let's see here. So this individual has heard their investment rather has been largely through an employee plan, where they have not worked for decades but continue to see very nice gains just using a buy and hold strategy. I now have most of my funds in stable value. How could they use dollar cost averaging in this scenario where they cannot contribute any new dollars? So is there any way to do that?
Yeah, so if you have money already in the stock market, I would just recommend leaving it in there. So the only way you could really do it if your money is fully invested is by selling some and then dollar cost averaging slowly. My advice would be, if you already have your money in there, then just kind of leave it in there. Of course, again, that's going to depend on the level of risk aversion that the investor has. So yeah, basically, whoever had asked this question is already made the right moves. The money's already in the 401k. It's already tax advantaged, at least when you give the money to the plan. And I'd recommend just kind of letting it ride out.
You've kind of talked about the stimulus and potentially inflation and some other maybe some consequences going forward. But overall, do you agree with the government's strategy of increasing the deficit to soften this crisis?
Yeah, that's a great question. Haven't really thought it through, I suppose. I'm looking more at the stock market. Yeah, I guess I'd have to think that through more, Paul. So unfortunately, I can't give a good answer to that. I just don't know enough at this point. I'll say this though. I'll make this point. I'll say the stock market seems to at least have like the stimulus package. So the stock market's interpretation of events is probably going to be much better than my own interpretation.
Excellent. And then this individual says, I'm done investing and have entered retirement recently. The question is if I should leave the stock bond ratios as before or make serious changes. You kind of touched upon this, but didn't know if you wanted to add.
Yes, so I would say it would depend on what the stock ratios are right now. So if a person's in retirement already, then as I said, there's still going to be potentially decades of investing. So I'd say, yeah, it depends on what the ratio is. There's rules of thumb, and these rules of thumb seems to have changed a lot, so I don't even want to say what some are. But just in general, I'm a big proponent of investing in stocks for the long run. The long run meaning about, say, 10 years or so. There have been very few periods of 10 years or more where you actually have lost money in the stock market. So when a person is retired, they definitely want less volatility. There's no question. Things like income might be important. So investing in, let's say, like utility stocks, which provide dividends, and they're also tend to be safer than, let's say, high-tech stocks. Those things are going to be very important. So a lot of older investors in retirement do not want to take the risk. They don't want to weather out these storms like we've had. So again, that's going to vary from investor to investor, but definitely take a good look at your stock bond ratios, and retirement's really a good time to potentially revise them as it creates this, very big life event, and kind of can think about things a little bit more.
Excellent. Thank you very much. I think with that, what we might be able to do is just kind of look at the questions, and if there's any common answers, we can send it out in our follow-up email to folks, just to be mindful of the time. I just want to say thank you very much for all of your time and for all the information and your answering of the questions. And with that, I think we might want to start wrapping up.
Okay, well, Paul, thanks a lot. It was a real pleasure to be here. And so hopefully I provided some information that was at least somewhat useful to everybody.
No, it was wonderful. Thank you. And thank you everyone for joining us. We hope you join us for a future webinar.